Hello dear traders. In this video, I will show you how to trade using only the high and low yesterday indicator by analyzing price movement and paying attention to the dynamic support and resistance levels indicated by the indicator. This method is a truly professional approach. Why is support and resistance trading important? Support and resistance levels are used to identify potential entry and exit points. These levels are a fundamental tool for developing trading strategies by analyzing price movements. Let's start our analysis with the Euro-US dollar pair on a 2-hour time frame. In the initial image you see on the screen, we observe that the price touched the support line created by the indicator 3 times but couldn't close below the support line. Of course, at this point, I would like to draw your attention to a very important detail. Every time the candlesticks test the support line, the wicks ends go deeper into a lower level. This image is a trap designed to shake off every buyer who enters hastily into the market. By the way, let's quickly adjust the settings for the high-low yesterday indicator, and don't forget to subscribe to the channel and hit the like button, please. The upper line of the weekly period high-low yesterday indicator, which we have added a 2-hour time frame to, appears to have been breached. However, to clearly understand this picture, it would be advisable to look at the daily time frame. This way, we can zoom out on the chart, and with fewer candlesticks, we can see that the upward breakout may be a trap. We haven't changed the indicator's weekly period and switched to the daily time frame. As you can see here, despite the price breaking above the resistance line drawn by the indicator, the selling group is intervening in the market action and pushing the price strongly downward again. In fact, this strong selling movement is so aggressive that it reaches the support line of the weekly period indicator on the daily chart. It is important to know that price action tells everything clearly. An experienced trader over time can identify high probability scenarios by simply looking at the flow of candlesticks, entering a cycle of low loss and high profit. One of the best examples of this is present in this action. In the previous view, we saw that sellers responded vigorously to the upward break of the resistance line, but we also see that the buyer group is still tenaciously present in the market. Of course, it is evident that the buyer group is lying in wait in the gray-colored support zone we marked below. As the price approaches that area, an upward movement begins again, and the upper line of the indicator forms another level. The newly formed higher resistance line was breached to the upside as buyers persistently pushed the price higher, and even a valid pullback movement towards this resistance line occurred. After the current pullback movement, a bullish engulfing candle formation is now taking shape, signaling that buyers have taken control of the market. It would make sense to follow the lead of market makers in the buyer role and seek profits as this candlestick closes. I have tried to explain step by step how to enter a trade correctly. Success in trading is never a matter of luck because all market movements occur within a certain logic. That's why I always emphasize on my channel that you can achieve consistent profits from the markets throughout your life. Whether it's cryptocurrency, stocks, commodities, or forex, once you fully understand technical analysis, you become the owner of continuous profits. If you enjoy my educational videos, please don't forget to hit the like button. You can stay updated with the content by subscribing to the channel. Thank you. Now let's take a step-by-step look at an example of a short position and particularly understand the meaning behind the market's movements. As you can see on the screen, while the price was in an uptrend, there was a sudden and significant selling movement. Naturally, a massive red candlestick even pierced through the bottom line of the high-low yesterday indicator. Such abrupt surges and collapses usually occur due to the emergence of local or global sensational news. Professional traders often wait for the heat in the market to calm down and return to its stable character in such situations. Such sharp movements that can occur suddenly are quite risky. Therefore, for now, we are monitoring the downward breakout without opening a trade. And after 2 candlesticks, a weak but valid pullback movement occurred at the point I've marked. If a bullish engulfing candle formation occurs after 1 or a few more candlesticks, we can consider entering a short position trade. An interesting price movement has occurred, but if we keep the basic trading rules in mind, it will be quite straightforward for us. As you can see, after the valid pullback movement, a minor uptrend formed, and the price returned inside the high-low yesterday indicator. However, here, a clear bearish engulfing candle formation has emerged. Aggressive traders can enter the trade as soon as this candlestick closes. Cautious traders, on the other hand, should wait for the downward breach of the indicator's bottom line once again. Cautious traders waiting for confirmation didn't have to wait long because the indicator's bottom line was breached again after just one candlestick. Now, these traders can also open a short position trade. By carefully analyzing the price movement and integrating it with the high-low yesterday indicator, we once again achieved a great profit. Dear friends, I believe you have learned the rules of the trading strategy and how to use it. On TradingView, there are many indicators that draw support and resistance levels, just like the high-low yesterday indicator. You can also use these indicators with the same logic and execute successful trades using the tactics I have shown here. Until the next effective and profitable trading strategy tutorial video, goodbye.